at the end of September, end of third quarter of this year, the economy, we think, was about 9% in terms of activity below where it was at the end of last year. That's just unprecedented in terms of scale. Now, we think there will be a further downturn in the fourth quarter because of obviously the return of COVID. Not as big, but there will be a further. So I think it's quite likely that the economy will end this year probably around 10 or 11% below where it was in terms of activity at the end of last year, and that is historically unprecedented.
In terms of the measures you've announced today to try and deal with it, £150 billion of quantitative easing, why do you do that, and what's the intention?
Well, the intention is that we are putting, if you like, liquidity into the economy to enable people to use it, businesses to use it, households to use it. So we buy assets that are less immediately usable, and that has two effects. One is that it keeps the cost of borrowing down, and that stimulates the economy, helps us to meet our inflation target, because at the moment we've got inflation well below our target. And as well as doing that, it provides liquidity in the economy that aids people who want to do spending and investment, and that's what we need the economy to do. We need spending and investment to get the economy going again.
Can you give us an idea of how destructive a second imposition of a second wave, let's put it that way, has been to business and consumer confidence, the drivers of economic activity?
Well, it's been true all through this year that confidence in the economy, of course, has been at a low level. So although we had quite a rapid recovery of the economy during the summer, although still to a level well below where it was at the end of the summer, all the surveys of when people are asked about their confidence, they did not recover in the same way, not in the same way as we would see normally in terms of relationships. Now, I'm not surprised about that because, of course, underlying this, people are very nervous, apprehensive about COVID itself, about its incidents, the effects of it, and we saw that in terms of people's stated confidence.
Yeah, well, your predecessor described COVID initially as a sharp but temporary drop. What two words might you use when you're looking at the long term?
Well, I think the temporary thing is just how long is COVID going to go on for. The longer term thing is how much is the effect of COVID on the economy going to do two things. One is that it critically undermines the capacity of some businesses to survive it. Secondly, how much does it change the way that we all do things? The way we work, things we buy, the way we buy things. All of these things we're observing at the moment, obviously. The question is how long are they going to go for, and are some of them going to be permanent changes? And then how do we adjust the economy? Because economies adjust all the time.
Do you think there will be permanent changes?
I think there will be some permanent changes, yes, I think there will. I'd be very surprised if we came out of COVID with no permanent changes. And it's a matter then of ensuring that the economy adjusts to those permanent changes, so we don't get long-term unemployment, which is very damaging. History has shown us how damaging that can be.
A quick word on Brexit. You're forecasting a negative impact from Brexit, even with a deal. This is the worst possible timing, isn't it, to be doing this in January in the middle of this existing crisis?
Well, I think, first of all, that we've conditioned our forecast on the trade agreement being reached. I think that is the right thing. It's the government's policy. I think it's the right thing to look for a trade agreement and to get one. And of course, that process is still going on. The question you rightly asked then is what are the adjustment costs? Because of course it does involve the UK leaving the customs union, and it does involve the UK leaving the single market. Now, there will be adjustment costs for any trade agreement, and we talk to a lot of firms. Our regional agents talk to a lot of firms. We've tried to form a view on preparedness. But let me end with this thought. A trade agreement and a spirit of goodwill in which both sides say, let's make the adjustment to this new world as easy as we can do. And by the way, the UK government has said that it will by delaying the implementation of many of the new arrangements. But a spirit of goodwill in that's achieved will minimise that cost.
Does it follow that if there's no deal, the hit to GDP will be greater?
Well, broadly, yes, it does. I mean, obviously, the no deal, of course, tends to be a sort of very thin trade agreement. Actually, that's the way to look at it, really. And yes, of course, obviously, the less trade that goes on, and the more there is an adjustment to that, then certainly in the short run, certainly the effects will be larger.